BlackRock Coffee Bar missed Q2 2026 consensus earnings per share by a penny. They reported 6 cents against a 7-cent estimate.
Right, but the revenue hit $63 million. I mean, that is a 25% year-over-year jump.
Exactly. And management immediately raised their full-year adjusted EBITDA guidance to between $34 and $35 million.
Yeah.
Plus, they bumped the new store target to 38.
And the stock reaction was just wild. Total whiplash.
Oh, yeah.
It had this initial 5.5% dip in regular trading, but then it violently reversed. We are talking a massive post-earnings rally, closing up between 12 and 19%, well, depending on the session you look at.
So for you, the retail investor listening, seeing a stock explode upward after missing earnings, well, that is a glaring signal that the headline numbers do not tell the whole story.
Exactly. The market clearly saw something under the hood that it loved.
Right. So our mission in this deep dive is to figure out exactly what that was. We need to look at the physical reality of what is happening at these stores. Like, we will examine the bizarre tension between their individual coffee shop profits and their, corporate overhead.
Yeah, and we'll look at the mechanics of what people are actually buying at the drive-thru, plus how they are forcing their way into the California real estate market.
And finally, we have to look at a looming class action lawsuit, one that accuses management of hiding a massive flaw in their growth strategy.
Because, when a stock commands a valuation premium this steep, we are looking at over 100 times trailing earnings. The market is pricing in absolute perfection.
Zero margin for error.
Yep.
Every single operational metric carries immense weight here.
Totally.
So I want to start with this profitability disconnect, because looking at the income statement, it honestly feels like two completely different companies.
It really does.
You have the individual stores, right? And then you have the corporate headquarters. At the individual store level, profits jumped 28.1% to $19 million.
Which expands their store-level margins to 30.2%.
30.2. I don't care what retail sector you are in, keeping 30 cents of every dollar at the store level is elite.
Oh, it is staggering for a brick-and-mortar chain, and they achieve that by driving a massive efficiency in their raw materials. Like, they squeezed out over 2% in savings just on the cost of beverages, food, and packaging.
So the individual locations are incredibly well-run machines.
Yeah, exactly.
But then you zoom out, right? You roll all those highly profitable stores up to the consolidated corporate level, and their overall profitability margin actually shrank.
Right, the adjusted EBITDA margin.
Exactly, compressed down to 15% from 16% a year ago. So if the stores are printing money, what is draining the bucket at headquarters? Like, is this just corporate bloat?
Well, it looks alarming on the surface, sure. But the filings point directly to the physical costs of scaling a newly public company. You have incremental costs dragging down that bottom line that simply were not there last year.
Okay, like what?
Well, they spent over $1 million on equity-based compensation alone. Plus, there are heavy investments in corporate marketing and digital teams to actually support this expansion.
Right.
But the real anchor here, the big one, is the pre-opening expenses. They burn $1.3 million just on stores that were not even open yet.
Wow. So that is like 2% of their total revenue. Break that down for me. What does a pre-opening expense actually look like on the ground?
Think about the physical timeline of opening a drive-thru, right? You do not just flip the sign to open on day one.
Right, there's buildup.
Exactly. 2 months before that store serves a single cup of coffee, you are paying rent on the dirt. You are hiring salaried store managers,
Oh, so you are flying out corporate trainers, paying baristas to practice making drinks in an empty building.
Yep. So when you open 10 new stores in a single quarter, bringing your system-wide total to 200, you are absorbing all of those payroll and leasing costs up front.
Okay, so management is arguing this margin compression isn't a structural flaw. It is just the temporary pain of front-loading their growth.
Exactly. They expect to leverage those corporate costs in the back half of the year once those new stores actually start generating cash.
But, that entire thesis rests on the assumption that these stores will actually draw a crowd.
Yeah.
Which brings me to the transaction data.
Okay.
So this is their 14th consecutive quarter of positive same-store sales growth. Sales are up 4.2%.
And if you look at the 2-year stack, they are up 15.1%.
Right. But here's the catch. The actual number of transactions, the sheer volume of cars pulling up to the window, dropped by 2%.
Yeah.
So how do they hit a revenue beat if fewer people are buying coffee?
Well, because the people who did show up paid significantly more. check sizes grew 3.8%, and straight price hikes added another 2.4%.
Okay, my immediate skeptical reaction to that is they just jacked up the prices and scared away the foot traffic. I mean, if you raise the price of a latte by 50 cents, eventually people stop coming.
Right. I mean, that is the logical assumption. But management addressed this traffic dip directly. And it wasn't a demand issue. It was a self-inflicted technological wound.
What do you mean?
Well, they spent the quarter migrating their entire customer base to a new loyalty data platform.
Okay, but how does an app update cause a 2% drop in physical drive-through traffic?
You have to picture the reality at the drive-through window at 8 o'clock in the morning.
Rush hour.
Right. If you force your customers to download a new app or reset their passwords or figure out a new rewards tier while sitting in their cars, you add 15 to 30 seconds to every single transaction.
Oh, man. It is like changing the tires on a moving race car.
Basically, yeah.
Or like forcing a crowded commuter highway to stop and install new Easy Pass toll transponders during rush hour.
Yeah.
You're intentionally creating a massive short-term traffic jam.
Exactly. Cars are backing up into the street, people see the line, they get frustrated, and they drive down the road to a competitor.
But you take the traffic hit today because you know the new toll system will let them drive twice as fast next month.
Right.
Because you get better long-term data capture.
Yes, that is the exact mechanism. You endure the physical friction at the window to secure better data and targeted afternoon offers for the future. And, we don't have to guess if that highway toll analogy worked out.
Right. We have the July data.
Exactly. Management gave us a real-time data point on the call. In July, the very first month of the third quarter, transactions turned positive again, hitting plus 1.7%.
So the friction cleared, normalization took hold.
Yep. The loyalty pressure has completely faded.
Which is vital, considering loyalty participation is massive for them. Like 68% of all transactions are tied to that program.
And digital sales, app orders and third-party delivery, those improved to 17.2% of total revenue.
But if foot traffic was choked up by the app in Q2, and they still hit those elite 30% store margins, it means they're doing something incredibly deliberate with what people are actually ordering.
Yeah, it comes down to menu mix. Specifically, food attachment and energy drinks.
Let's get into that.
So 13% of all orders now include a food item. That is largely driven by a massive system-wide rollout of grilled cheese sandwiches and egg bites.
See, I have a really hard time squaring that circle. Historically, food is the absolute margin killer for a coffee shop.
Oh, absolutely.
You deal with spoilage, specialized heating equipment, longer prep times, and the markup is terrible compared to just a cup of drip coffee.
Yeah.
If they are aggressively pushing grilled cheese sandwiches, how on earth did store-level profitability go up?
Well, you are looking at the sandwich in a vacuum. You have to look at the entire ticket. This is a textbook margin barbell strategy.
Okay, explain that.
So yes, the food inherently carries a lower margin, but nobody goes to a drive-thru at 2 o'clock in the afternoon just for an iced coffee.
Right, they want a snack.
The food is the bait. It drives the afternoon visit, and when that customer orders the grilled cheese, they pair it with the high-margin item on the other side of the barbell.
Which, for BlackRock, is their fuel energy drink platform, which has accelerated to nearly 27% of total sales.
Exactly.
I mean, we have to pause and just appreciate the sheer physiological chaos of this order.
There is a lot.
We are talking about a customer eating a heavy, melted grilled cheese sandwich and washing it down with a proprietary glowing neon blue energy drink at 2 in the afternoon.
Yeah, it is a nutritional wild card. But financially, it is a masterpiece.
How so?
Because the grilled cheese pays for the overhead of keeping the store open, staffed, and the lights on in the mid-afternoon, which is a time when traditional coffee shops are completely dead.
Oh,
And then the fuel drink, which is essentially highly profitable syrup, water, and caffeine, drops pure margin straight to the bottom line. It effectively defends that elite 30.2% profitability while expanding the hours they can actually make money.
And they are actually leaning into that, right? They are currently testing a 1-hour extension of their operating hours at select locations to capture more of this evening demand.
Yeah, it makes total sense. If you have the afternoon code cracked, leave the lights on longer.
Okay, so the menu innovation is optimizing the stores they already have. But when I look at their capital expenditure, they're not just trying to sell more sandwiches. They're trying to blanket the map.
Oh, aggressively.
Yeah, they raised guidance to 38 new stores this year with a stated goal of hitting 1,000 units by 2035. And the tip of this spear for this expansion is California.
Yeah, to understand the economics of this company's future, you have to look at how they are attacking California. All of their new stores out there are drive-throughs.
Which insulates them from some of the local zoning and competitive pressures.
Right, and the unit economics are wild. New California locations are trending toward $1.6 million in average unit volume, or AUV, in their very first year.
Wait, 1.6 million in year one? But building a drive-through in California is notoriously expensive. The real estate costs, the labor, the permitting. Isn't that margin suicide for a growing brand?
Well, it would be if they were building from scratch, but they are utilizing a strategy called conversion real estate. They aren't buying empty dirt and pouring concrete.
Okay, so what are they doing?
They are finding old, abandoned bank branches or defunct fast food pads that already have a drive-through lane built. They strip out the ATMs, throw up the BlackRock branding, drop in the espresso machines, and they flip the building in 3 to 4 months.
Oh, wow, so it keeps build costs manageable.
Exactly. And while occupancy costs in California are naturally higher, they operate on the highest pricing tier in their entire system out there. So that 1.6 million in volume completely offsets the rent.
That is fascinating. I want to look at the balance sheet, though,
Yeah.
because the cash required to execute this conversion strategy is intense.
It is. Their CapEx guidance for the year is $42 to $43 million.
Right. And management specifically highlighted that roughly 30% of that, so $13 to $14 million, is deliberately being pulled forward. They are spending it right now to fund the pipeline for stores opening in 2027.
Yeah, they are.
But here is my question. They only have $16 million in cash on hand and $30.6 million in debt. Burning a third of your annual budget a year early, I mean, is that a sign of immense operational confidence, or is it just a risky burn rate?
It is a calculated burn rate that favors operational certainty over cash hoarding. Look, the biggest threat to a retail expansion isn't construction costs, it is municipal permitting delays.
Okay, fair.
If a store is budgeted to open in March, you are relying on 9 months of revenue from that location in your annual forecast.
Right.
If the city delays the electrical permit and you don't open until September, your entire earnings model misses consensus. So by deploying that $14 million now, they lock in the general contractors, they secure the real estate early, and they guarantee those stores actually open on time.
They're buying schedule certainty.
Exactly.
Okay, you buy certainty with the early spend. But aggressive expansion always carries the risk of tripping over your own feet.
Oh, definitely.
Which leads us to the most notable risk hanging over BlackRock's stock right now. There is pending class action litigation regarding store cannibalization.
Yes, this is a critical factor for any retail investor looking at the long-term viability of that 1,000 store target. The deadline for institutional investors to seek lead plaintiff status is coming up on August 17th, 2026.
Right, and to be clear, for you listening, we are impartially analyzing the facts of the filings here. We are not taking sides on the legality.
Right, just looking at the facts.
So the core allegation from the plaintiffs is that BlackRock's post-IPO disclosures concealed the reality of their real estate strategy. Specifically, the lawsuit points to a 160 basis point sales transfer headwind in Phoenix.
Yeah. In plain English, the plaintiffs' alleged management got greedy. They built shiny new drive-throughs so close to their own existing high-volume locations that they accidentally stole 1.6% of their own sales.
Basically cannibalizing their own registers to artificially inflate the total score count before the reality hit the earnings report.
That is the core of the lawsuit, yes. Management, on the other hand, addressed the Phoenix situation directly on the Q2 call.
What was their defense?
They stated the sales transfer impact was a modest headwind that is actively declining. They characterized those moves not as cannibalization, but as strategic, intentional relocations to better real estate.
Okay.
And they noted they will lap the majority of that impact in the third quarter with no future headwinds expected. Plus, they emphasized that moving forward, their real estate team is utilizing much stricter data-driven spacing discipline.
So what does this mean for the retail investor holding the bag? Because these allegations remain completely unproven in court.
Right, they are unproven. But the legal overhang itself is a tangible risk. I mean, defending a class action consumes millions in legal fees. It distracts the executive team.
Oh, absolutely. And the potential reputational damage, too.
Exactly. But the bigger risk here is multiple compression. If Wall Street starts to believe that BlackRock has to cannibalize its own core stores just to maintain its aggressive unit growth rate, investors will absolutely refuse to pay a premium for that growth.
And that premium is currently massive. Let's do a quick valuation check as we wrap this up.
Yeah, it's high.
Despite the huge post-earnings stock rally we talked about at the top of the show, BlackRock commands a steep valuation. We're talking over 100 times PE. That leaves very little margin for error.
Right. D.A. Davidson actually recently cut their price target on the stock to $10. They explicitly stated they are applying a 13 times multiple on their estimated 2027 EBITDA.
Wow.
Yeah. When you are priced for perfection, you have to deliver absolute operational perfection. You cannot afford self-inflicted wounds like placing stores too close together, not when the market expects flawless execution.
Which leaves you, the listener, with a final analytical thread to pull. As global coffee commodity costs finally start to moderate in the back half of the year, BlackRock actually has a clear tailwind to protect those incredible 30% store-level margins.
Definitely a positive for them.
But with a massive valuation premium and a relentless march toward 1,000 stores, the ultimate test for this company won't be if they can sell more neon energy drinks and grilled cheese sandwiches in the afternoon. The real test is whether their real estate team can execute aggressive infill development without cannibalizing their own golden locations.
It really is the ultimate balancing act of scaling a retail brand.
Be sure to follow the show for your daily retail investor earnings coverage.